Ask someone how banks make money, and you'll usually hear the same answers: overdraft fees, monthly account fees, ATM charges, late penalties. It feels right, it feels obvious. Banks charge fees, people get mad, banks profit. That's the surface story, and it's comforting. Because if banks only made money from small, visible fees, then avoiding them would be easy. Just don't overdraft, don't miss payments, use in network ATMs, problem solved. Except that's not where the real money is. Fees are noise, they're irritation, they're predictable revenue, but they are not the engine. The real engine is quieter, it's mathematical, it's systemic, it's built into the structure of how money moves. And once you see it, you realize something uncomfortable. Banks don't need you to fail, they need you to participate. Because participation alone is profitable. Even if you think you're winning, let's start with what's true. Banks take deposits. You put your money into a checking or savings account. That money doesn't just sit there. Banks lend it out. Mortgages, auto loans, business loans, credit cards, they pay you a small interest rate. They charge borrowers a higher interest rate. The difference is called the spread. If they pay you 1% and charge someone else 6%, that 5% gap is profit. That's basic banking. And yes, that's real. But here's where people misunderstand the scale. Banks don't just lend your dollar once, they multiply it. Through fractional reserve systems and modern credit creation, a single deposit can support multiple layers of lending. Money isn't just stored, it's leveraged. And leverage is where the exponential profits begin. But even that isn't the deepest layer, because the most powerful money banks make isn't from loans alone, it's from behavior. If you want to understand modern banking profits, look at credit cards. Most people think banks make money from people who miss payments. They imagine reckless borrowers drowning in debt. But the most profitable customer isn't the one who defaults. It's the one who carries a balance, consistently, predictably, for years. Not maxed out, not bankrupt, just revolving at 18%, 22%, sometimes 25% APR. That interest compounds monthly, quietly. And here's the part most people miss. Even people who pay on time can be profitable, because banks also earn from interchange fees. Every time you swipe a credit card, the merchant pays a small percentage, usually 1.5% to 3%. That fee goes through payment networks and issuing banks. So even if you never pay interest, you're still generating revenue. Now think about scale. Millions of transactions every single day, globally. Small percentages, massive volume. Banks don't need drama, they need activity. They make money when you borrow. They make money when you spend. They make money when you revolve balances. They make money when merchants process payments. The system is layered, and most users only see one layer. Here's something most people never think about: float. When your paycheck lands in your account, that money doesn't instantly disappear when you swipe a debit card. Transactions settle in batches. Clearing takes time. Funds move through systems. During that window, banks control enormous pools of capital, and large institutions invest short-term liquidity. Government bonds, overnight lending markets, interbank transactions. The difference between holding billions for even 24 hours and deploying it strategically is significant. Individually, your balance seems irrelevant. Collectively, it's powerful. Banks operate at scale, and scale transforms pennies into billions. The average person thinks their $2,000 checking balance doesn't matter. Multiply that by tens of millions of accounts. Now you understand why liquidity is king. Banks monetize time, even tiny slices of it. Here's the real insight. Banks make money from predictability. They analyze behavior, spending patterns, repayment habits, income consistency, credit usage, risk tolerance. With enough data, your financial life becomes statistically predictable, and predictable behavior allows precise pricing. High-risk borrowers pay higher interest. Stable borrowers get lower rates. Credit limits expand gradually to maximize usage without triggering default. It's a calibrated machine. Banks don't want chaos. They want steady, predictable cash flow. Late fees and overdrafts are spikes. Interest streams and transaction fees are rivers, and rivers are more valuable than spikes. The system is not designed around catching you, it's designed around keeping you engaged long term. Because the longer you stay inside the system, the more valuable you become. So what does this mean for you? First, understand this clearly. Banks are not evil masterminds. They are structured profit machines, and machines follow rules. The more you understand those rules, the less emotional your decisions become. Second, if banks profit from your balances, your borrowing, your transaction volume, and your predictability, then your power comes from controlling those variables. Use credit without paying interest. Maintain liquidity without leaving excessive idle cash. Avoid unnecessary borrowing, but leverage strategically when returns exceed cost. The goal isn't to avoid banks. That's unrealistic. The goal is to interact with the system intelligently. Most people operate passively. They deposit, they swipe, they borrow, they repay, without ever asking, how does this benefit the institution on the other side? When you start asking that question, everything changes, because once you understand how banks really make money, you stop being surprised, you stop being emotional, you start being strategic. And in a system built on predictability, the least predictable customer is the one who understands the structure.